Hey traders, welcome back. Lesson 3. We hope you had a good time in lesson 2, principles of future spreads. Let's go ahead and just get on into that. Let me put that up there while I talk a little bit just to get that out of the way. If you have not already memorized a disclaimer, boom, there you go. Lesson 1 through 4, as I keep saying, and I'll keep saying again, basics, principles, advantages, things like that. Just to grasp again while you're in this full session and keep everything warm in your head and make notes thoroughly one time around. I'm going to go through the next few slides, the participants of future spreads, who they are. You've seen how thick the liquidity is, right, of these spreads. You see a lot of big professionals, and we keep talking about how they play in that market, and that's what we're going to do. So we're going to take advantage of where the pros are, where it's safer to trade and have, still a good opportunity to make good profits based on our investment amount. So we're going to go ahead and get into that. The participants of future spreads, the trades, who they are, and just the definitions and stuff. I might go ahead and get into show you where to find a monthly COT report. I don't teach people how to use that here. However, again, I want to compile all the possible tools and resources in one boot camp so you know every possible tool that traders use in the spread market, spread traders use, okay? Some people in the prior lesson we talked about, when we spoke about the different curves and trading off the different curves and backwardation and contango, some people trade off what's called these COT, commitment of trader reports. They're built weekly, and let's go ahead through the terms real quick and we'll talk about that. The producers, okay, these are the farmers, the miners, the oil drillers. These are big. This is the main reason why the exchanges, the future markets were made, right? So let's go ahead and read through. The producer grows mines and drills the material up and out of the earth to sell the product or the commodity for a profit, okay? Another example, an oil driller that is drilling at an oil well is worried about falling prices in the future. He or she needs to protect against prices going down in the future. So when he or she is ready to sell, when they're ready to sell, they're kind of concerned about, is that future price going to possibly change? Is this for seasonality reason or supply? So what they'll do is they'll hedge, they'll spread a trade. Okay, they'll go against their own product. They'll sell the spread so that they can take delivery of that price at a future price. They can lock in a profit. So if for whatever reasons into the winter, oil or whatever that energy product, let's say, is selling cheaper for supply reason and seasonality reasons, they can lock in and estimate what their profit margins will be up front. So they're not taking a blind run at it. They're doing their numbers. These are professionals. In order for them to stay in profit, they need to be able to hedge. So a big portion of these trades, big portion, is them. They're the producers. The commercials comes next. These are people that buy from them. Okay, these are people that they're not institutions. Okay, they're actual people. Let's explain that here. The entities, large companies that buy products from producers directly on behalf of the companies they work directly with, maybe indirectly, that create final products that they deliver to the public. Example: a jewelry company, a refiner of fuel, or a candy producer that needs to use, let's say, sugar to produce their sweets, coffee resellers that use beans. There are even meat producers that need to produce, purchase grains to feed their animals for the future. So these are people that are, this person, normally, they're afraid that prices will go up in the future. Okay, the commodity will get expensive. They're concerned on that. So they want to lock in a price now, let's say, they'll buy sugar so they can produce, let's say the company Hershey's. So they can produce and calculate their profit margin in the future on the chocolate that they sell and distribute and all that stuff. They have to know. So they don't want to have a sudden increase in sugar because of some kind of lack of harsh weathers, that may affect crops, that then affect, the producers from producing on a more affordable sugar for them. So they'll lock in and, they'll buy up that stuff. So they're buying, the producers are selling to lock in a profit, and the commercials are buying, to lock in from fear of increase. Okay. So, they'll go long on their future prices to create the offset. hedge against their future purchase to protect their business. Then there's the good old speculators, which is us, and also really just their big, institutes too. Okay, now in COT reports, these are separated. I'll kind of break that down real quick when we get there. I broke this down a different way on the spreadsheet, so we know every position, every person in a group segment, and then as you start reading like commitment of trader reports, you'll see that there's groups called like non-commercials, commercials, and then you'll see which non-commercials will end up being like the big speculators. Then there'll be another group called like others, and those are usually us and other maybe like small, super tiny, small institutes that may be using extra funds that are, I believe as of today, it's 100 contracts or less. So it's somewhere like around 99 contracts or less. If you're trading anywhere under that, you're an other. I'll show you that visually so it makes sense. So let's move forward. The speculator, they're not a producer physically, or or uses any of the commodities physically, right? We're just speculating. It's limited on experience that they can risk losing a lot of money. But if he or she knows what they're doing, understands spreads, cycles, seasonals, how they work, then he can make money without being end of the other positions in the market. Okay, most participants in the market are speculators, as you see open interest or basically physical deliveries never really taking place to a speculator. And they say on average, this is a number that I heard, it's about less than about 5%. So it makes you think why these type of instruments are not spoken about on Facebook, Instagram, or YouTube much, right? They're not publicly spoken about. We hardly hear about these. Somehow you ended up here. Somebody either invited you or you barely heard about this, maybe on YouTube. Not a lot of people talk about it. So, they want you to take higher risk so they can take the lower side risk, and when other people are being invited to trade futures on outrights and they're, don't have any clue about spreads, you are providing liquidity to the markets. And when you're providing that liquidity and have a lack of a kind of understanding who these other players are and how they're trading and what their positions are, you could become real, I don't know how I should say this, a victim to some of these positions, because it's easy to get stopped out on outright trades. We've spoken about that. It costs a lot of money, and a lot of times we may not know what we're doing because we don't know what they're up to. If we don't know that they exist, then it's just that much more difficult and disadvantage to us. Okay, and we're not at an advantage. So understanding these positions, who they are, what they are, where they're reported and stuff is, very important. Before we get into the next section, which is just a little bit more of context of spreads, we've spoken about it, basics, we're just going to do that again. I want to pull up the CFTC website, show you how to pull that up, just even through Google searching it, so you have a note of that, and start kind of dabbling with it, play with it, and look at it, okay? Let's go over there next. If you type here just like on any Google search or MSN search, I did this on purpose because I want you guys to be able to pull up something like this, CFTC COT report. If you do that, it'll pop up the first result here. It's commitment of traders. It'll take you to the cftc.gov website. Just make sure it's the governmental website, which is basically the commission, the U.S. Commodity Futures Trading Commission, okay? It'll take you, it's a direct link that'll take you to the commitment of traders page, so you're not having to dig through all this stuff. And as of the time that I'm recording this video, guys, we have a government shutdown. Our government was supposed to be back up after being closed for, I think it was like 6+ weeks, close to. And our commitment of trader reports, they're printed weekly. They're reported weekly by all the big institutes, producers, funds, and thus another great reason to be trading these things is because it's so highly regulated. They have to report their positions weekly. Now there's a 3-day grace period, a cushion in this. So when these reports are printed, they're printed every Friday to the public. Every Tuesday is the deadline that the big guys have to report all their volume in, okay? Including yourself at home. If you're big and you're trading over 100 contracts a month, you have to do a report. So anything over that, you're falling into the reporting guidelines. Regulation, it helps us because it gives transparency to the markets and we can read these reports. So We came out of as you see here, the special announcement, January 30th. We came out of a government shutdown. We were supposed to have reports coming out for tomorrow. The expectation is for the 1st, which is a Friday of February. Doesn't look like we're going to have that because of some kind of appropriations that were suspended. So we haven't had a report printed out since December 18th. If you go down here, down in the page, you'll see December 18, 2018 was the last time we had the disaggregated and all the reports. If you go down to the current legacy reports, you can start here with the Chicago Mercantile Exchange. Take a moment to look here, guys, where it says futures only. If you go down to Chicago Mercantile Exchange, click on the short format. Don't ever have to click on the long format. Click on short format. And there you go. You can print this up and just start reading through it. It looks a little confusing in the beginning, but each commodity has its own little square. Okay? It's a quick little short version. Like here, for example, you have milk. Let me highlight it. Here's butter. Here's non-fat dairy milk. And there's certain exchanges in here. The main one, Chicago, the Merc, will have like lean hogs. They'll have some of the main contracts that we trade. For example, here, let's say like feeder cattle. See that? Feeder cattle. And this was our last report. December 18th was a Friday. Everything was reported on that Tuesday of that week. And you'll have here the non-commercials, which are like the institutes, the funds, the commercials, okay, the producers, the farmers, and all that stuff. And this is just a total of that. And here's non-reportable positions. So these are these are speculators across the world. These are us, okay? And it just breaks down by long, short. Now you also have your spread positions, so we can see how many people are spreading there, how many contracts are spreading, not how many people, the number of units of contracts. And what people do here, guys, as a strategy is some people, what they'll do is just like I was talking about trading curves and contangos and stuff. What they'll try and do is build spreadsheets on this and create relative percentage changes on a spreadsheet. And maybe particularly only just follow like a few of these things because you only need to follow a few. Some people only need to trade. I mean, you can make a whole living just trading like one commodity. Okay. And what they'll do is they'll read these reports and they'll start seeing where the non-commercials, the professionals, basically, the people that know stuff are trading, are exchanging between their long and short positions. You'll start seeing them change. If you just try to trade this off on a weekly basis and just start gutting it, you can get hurt. But if you start seeing changes every week, where shorts are becoming more long, or more long commercials are going more short bias versus long. They're changing their positions over. You can start gauging where the markets can go. There's delays in these stuff. You know, when they're moving big volume around, you can see a delay in the price action. But if you're a technical trader too, you can utilize this stuff to try to line it up with the technical area, with the key area, and start seeing where commercial, like professionals, are moving positions around and where there might be possible turn. This is a strategy that professionals use. Is basically using fundamentals. Now people will turn around and they'll use these and make indicators out of these stuff and have them displaying on charts. It's all going to be your preference. I don't trade it. I'm still very interested in it though. I'm interested in looking into them and actually going more deeper into building spreadsheets to start gauging differences on a weekly basis, to start seeing that. But just to add it as an ammunition into my trading. So I want you guys to get familiar with that. Who the different participants are, why they are there, why they do what they do in the future and commodity markets, and this awesome transparent report that you can pull up from the CFTC website weekly. Okay, so we expect to see something going back here soon where we're back to our weekly reports, guys. This has been a pretty long little furlough of workers here. It's not normal. It's not normal, but for the last few weeks with us, this has just been our situation at the time of recording this. Don't plan on seeing this constantly like that. That's just a little hurdle we're going through there. So we don't know. And it's kind of what it has done to the markets too, is it's pretty much kept things on a very sideways market as well. I mean, myself, I was in a cotton trade since December before Christmas. between this furlough and China not buying stuff from us, just we've had a lot of sideways markets in the commodities, just because we just don't know at the moment of this recording. We just don't know where things are going to. We don't know where positions commitment of traders are. We have no idea since before Christmas. And, people trade off that. Me personally, I don't, but I've seen a lot of my trades going sideways because of it. It only makes sense. Hey, China's not buying. Big players aren't buying. They're working out trade talks with us. At the same time, we have government shutdown. So we have lack of data report where other traders and professionals like to trade off of that. We've just had sideways markets off almost everything. Cotton, hogs, cattle's been almost playing sideways. I'm in a live cattle trade right now. As of the time we talk about this, I'm in a copper trade, just sideways action. And so it's been a little bit tougher, but, understanding the fundamentals and why gives us another edge and understanding, so we're not in doubt and question. Okay, this is why this is going on. I understand that. Let me move on to something else in the meantime, or play something else. So have an edge, have the information. This is what this boot camp's here for. Let's move on. Didn't know where I should have really placed this thing. I should have just placed this maybe put in the prior lesson or so. But again, finishing principles, I figured it's still a little bit more context. Again, guys, the spread between the bid and ask. Remember, you'll hear relative words sometimes in the markets here. Okay, for you newcomers, especially taking notes. When they say, "Oh, what is the spread between the bid and ask?" There's a spread between a bid and ask, and in very light liquidity markets, like if you were trading crude oil alone, the price between these are the price that they're selling for. Okay, this particular commodity, whatever it is, I don't have a name here on purpose. These are the buyers willing to buy at this price. These are the sellers willing to sell at this price. In between this, there is no gap, so there's really no spread. Okay, there's nothing. It's just nice and tight. Okay, there's no spread. It's just like one tick spread, they would call it. There's no spread here. It's nice and tight, and that's what you want. You don't want to be trading stuff that has light liquidity. Light liquidity meaning that there's like 1 people here, 2 here, 10 there, 11 there. You want this nice thick liquidity. Okay, a lot of contracts trading at prices, and it's not. There's no big spread between these. Sometimes at nighttime, if you sit there and look at the S&P contract or crude oil contract, you'll see 3, 4, 5 tick spread wide price gap between a seller and a buyer participant. Okay, and so that causes those whippy markets. So want to make that clear right there. In the prior lesson, we went through this, so I'll keep this short. Option sellers, they hedge strategies in premium in options. This is just an option. An option table here. Now, I want to display it again and let people know. A lot of times, even when I talk to brokers, I talk to some brokers sometimes that aren't even. I don't feel they're educated enough on future and commodity spreads, and it's not to down them. It's just the experience level's not there. So the first thing when I'm talking on the phone with certain brokers, I cannot say names, and they just go, "Oh yeah, option selling." They just jump to this. A lot of the ones that are fresh just aren't that seasoned and don't know about future spreads. It's crazy. It's just the truth. I've been doing this for years, and it's just they don't know. They'll start talking about this, and people out there in the world, you'll be talking about future spread trading. They're gonna visualize this right here, options, an option table, and they're gonna kind of visualize people that sell option premium. So it's a hedge strategy. From what I know and as how far this dates back, options themselves on stocks and on commodities were created as an actual hedge tool for big professionals against the actual commodity or stock itself. So originally, or even I enjoy sometimes as like a little lottery to like buy an option outright, just kind of test my technical skills and take advantage of a rapid move, a volatile kind of a high beta stock. I play them. A lot of times, really, it wasn't really created for that. It was created for these hedge strategies. So Know it. Know what separates you from everyone else out there. That's why I keep being a little redundant about the basic info here in the first few lessons. You're not an option seller. You're a future spread trader. You're a commodity spread trader. It's actually, in my opinion, a bragging right. You're blessed. So that's about it. That's what we are. Back to that. Future spread trading, a future spread trader, a commodity spread trader. We're the speculators, okay? And we're speculating on the increase, which is a widening, or a decrease, a narrow of a spread, which is basically the action of the relative price movement between the position long and short legs or vice versa, okay? Seasonality is our core basis for spreads, as they have the most highest market predictability, and thus it gives us an actual statistical edge, a historical statistical edge in our trading. We use spread line charts to display the data of the two legs, followed with the ratio, which is the difference between the front month subtracted by the back month, okay, for price. That's why you see a lot of like negative price ratios, okay? So, sorry guys, we'll explore this now. I'll use the laser pointer on the next slide to show and aim at a few of these things. It is a little bit small. At the top here, we have the February crude oil contracts for February 2019. Okay, this is relatively fresh data at the time that we recorded this. And this is basically the outright crude oil contract as a line chart on our seasonal algo spread platform. Okay. The red line here is an entry point that we have drawn to show and reflect the same entry area as our spread here. And the green line is the same line drawn on the same exit date that we have drawn on our seasonal entry recommendation here. Now, the price on this February contract right here at this red line is down here. It's at $68. It's September 1st is the date of 2018. And the February contract is trading at $68.89. Okay. On the bottom here, CL March 19 is this code. CLH stands for March. You would think it should be M. That's another day, another topic debate. CLH19. And on that entry date, 68 of September 1st, 2018, okay, on the entry date, this 2019 contract of March was priced at $68.59. If we subtract the front month, okay, by the back month, we would get a spread difference of positive 30 cents, okay? So if we look at this chart here, which is a spread trade, CLG19 minus CLH19, which is February, minus the March contract, we now have a spread. In the prior lesson, I mentioned how this is much smoother at times. At most times, it can trend better than the actual outright. The actual outright kind of trends here overall at some point. But the first month, as you see, there was a little rally up before, a little rally up on both sides. Pretty relative because, most months will do the relative thing of the other month, with just a small ratio difference here, as you see down here. But overall, the spread itself traded much better on our entry. And that's why our platform made a recommendation to us to take this trade. And so if we entered this trade on September 1st and we sold it, right, because our entry is a sell, we want this thing to narrow, not widen. We want it to decrease, okay? We want the ratio to decrease. So we would sell the February contract and we would buy the back end March contract. That's it. It's a futures trade. We're just doing two combined, two contract, one sell and a one purchase. Okay, we're doing a crude oil future spread. And this spread actually took several months to get out. The exit date was projected for January 1st. And if we held that long per contract, you would see that in January 1st, the crude oil price for the Feb 19 contract was down to $46.58. And the March contract was down to $46.90, where our ratio here, this is a little bit small, but the actual price of the spread is now negative 32 cents. Okay, so this is a total difference, plus 30, subtract negative 32. Okay, this is a total difference of 62 cents. Okay. And in the crude oil market, the spreads, they're all priced the same way as the futures outright. In the crude oil market, each tick is priced at $10. Each tick, which is like a penny. In crude oil, one tick is a 1 penny move. Each penny is priced at $10 up or down, meaning, as another example, a $1 daily move in crude oil, if you were trading just the outright, would be $1,000. Okay. So we've made a 62 tick gain here in this spread. We've probably spent no more than about $180 to $200 to get in this spread. We've never seen this thing move against us at all. Very tiny. I mean, it didn't even move against us since we entered this trade. This was a smooth trade if we got in here and exited January 1st. Per spread, we're up $622. Okay? You have a little bit late Christmas money. But this is one of the greatest examples I found I wanted to use. And obviously, I'm not sitting here cherry picking. This happens all the time. All the time. Almost all the time. Okay? It's not uncommon where this happens with spread trades. Okay? You could have been working and doing all your other little things in life, whatever it is you decide to do, little or big, and not sit there and try to trade crude oil every day and get whipsawed around $1,000 up and down. It would blow you out if you didn't have enough money. Or not just that. It's not just the money, the nerve. Do you have the nerve, to deal with that stuff? How many times you would have been stopped out here before you just said, forget it. This market's going long. And then it turns around, lo and behold, and it did what you wanted. Which was normally normal seasonal tendency, right? Crude oil goes down during winter months, right? They start cracking this oil into different things, and different stuff start becoming more expensive, like heating oil and stuff for the winter. But it didn't trend as well as our spread did, and our spread made easier money, right? So less anxiety, pretty good reward for the risk. I'd say it made more than our risk that we put out there. We put out very small margin, right? So this would be a good example for what we spoke about last lesson. Here's the spread trade and how it looks like on our Season Algo platform that we use, okay? So if this was a recommendation or something that a user brought up or I brought up, we build these. We're going to show you in the next couple lessons forward how to build these up. But just a quick snapshot of what this looks like, adding all the other statistical years, the historical years, is the black line here was the current spread. It's the February versus the March that I just showed you in the prior slide. Okay, our entry areas were here, September 1st into the exit of January 1st, 2019. Okay. The different colors are seasonal historical averages. So the red line up here, as you see, is the 5-year. So the red line here is the 5-year average. The last 5 years at that spread, how it moved. The green line is the 10-year average. The blue line is the 15-year average of how that same exact spread, the February versus March, but for all of those past average years moved. And the most volatile was the whole overall 30-year average here that you see. And I skipped over the 20. It's orange. Okay. So these are all historical combined spreads, how they worked and how they acted. Our platform here, according to what I learned and how it works, is about 60 days prior. Okay. 60 days prior to the platform itself finding recommended strategies for us, because this thing does find us, and this is why it's going to help us bootcamp members in the beginning a lot. It's going to give you recommended ideas, and that's the way it's going to help you discover strategies and hone in and figure out things that you like and fix yourself and adjust yourself to commodities that you prefer, and then share ideas in our Facebook group and kind of feel out what other people are doing with it. So it's going to help you adapt, create your own system, your own feet, your way, and also share. So that's what I talk about, sharing and growing. And so what this would happen is the platform itself will give us, and I'll show you in the next video that shows how to use this, will show recommended strategies. It's based on a 60-day front look, back looking forward of spreads that have likelihood of working out to a certain degree, meaning that I have good correlation with one another. They're not super spread out from each other, super volatile. So the more better correlated they are, it's going to automatically generate trade ideas. Okay, but we can't trust machines all the time. We can trust historical data. It's our job to still dig in and do research and things like that. So kudos, and I like the fact that we can have opportunities to discover by just the system that it generates recommended strategies. But from there, we can build so much more awesome. Lastly, guys, is another principle here for you guys to know, and you're going to take a total edge on this by most of you. It's going to be a big shocker and a big awe is, the risk component to purchase or sell of all these examples down here. I already gave it away at the top is the dollar-based currency. Okay. So, when you guys remember when we buy a home or we're buying bonds or stocks or even gold, for example, we are taking a systemic component risk, and that's against the dollar. Okay, we're taking a systemic risk against that dollar. You're buying something against something else, or you're selling something against something else. Example, a good one would be if you're buying gold. Okay, you're technically short the dollar. Okay, because if the dollar goes up, what happens to gold these days on the markets? Right, real simple. Think about that part, right? If the dollar goes up, gold goes down. So if you're long gold, you're short the dollar. Okay, so if you're long the dollar, technically you could be short, I guess I'd say gold, right? But we're talking about that dollar, and the dollar, how it ties to the currency, the base currency in the commodities world. Okay, so we use the home and we use the common stock, whatever, as a photo, and bonds. Because in relative trading to things, and especially gold too, it's a commodity. To give you and paint a picture, an example to you of how that systemically ties. I tried to talk to a guy in Europe about this the other day. He was talking about Tesla, and we talked about this topic, and he didn't get it. I wasn't going to talk long about it. It just didn't matter anymore, especially over beers. The thing is, guys, this is what matters. You have to know everything is a relative trade. When something is expensive, what is it expensive to? When something is cheap, well, it's cheap. What is it cheap to? What is it inexpensive to? So, the dollar in the commodities world is very important because things trade on the dollar. Like global people are buying things, sovereign countries buy things on the dollar. Using that as a base currency, like crude oil is the greatest example. When the rest of the world, China or whatever, is buying crude oil from us, they use the dollar. And that's why you'll see such a correlation, adverse relationship, I shall say, when the dollar goes up and how crude moves to it and react to it, because people get scared out there because the economy's strong here and the dollar goes up. Well, they have to use dollars to buy crude. So how does that react? So there's a systemic component there. The risk component is the dollar to, let's say, that crude oil. So and that's why things move the way that they do. So I want you guys to be aware of that. Here's an example of the crude oil. We were talking to the dollar. If you were short, essentially, to February crude oil, technically you're long the U.S. dollar. Okay, even though you may not know that. If you were just trading outright, crude oil. Same thing if you were long that same March crude oil that we were doing that spread on, just out by itself. Technically, you were short the U.S. dollar because that base currency, what the crude oil sells on globally, is the dollar. So that's why we use crude as a good example. But if we're spread trading this, and that's why I use these ratios, we're basically canceling the dollar out. And now we're just short Feb, long March, and we create that ratio, and we take that systemic hedge, that dollar risk out of it. And that's another reason why that volatility moves out of the way. It's not just the fact that we're taking that spread, and because we're short one month and the other, all the volatility goes down. There's that other reason that we're taking that systemic hedge and that dollar out. We're hedging from that. We're hedging away from systemic risk, okay, that the dollar causes. So Now, suddenly, if there's certain tweets, we will be affected based on tweets or Saudi Arabia saying something about production and these kind of geopolitical news regarding that, or a big oil headline. Oil moves based on a lot of headlines. Some guy with a lot of power that has a lot of followers, headlines something out there, it can move. But when the dollar now is doing something in relation to it, it's systemically hedged away, and we're not even concerned anymore about that. So I want this to be a main key point of the principles lesson here in lesson 3. Okay, key points, guys. I hope you're taking notes. I've enjoyed sharing this session with you. We'll see you in the next session.